Hello friends, welcome to our channel Accounts and Finance with FARSK. This is our series on the set of videos on reading the financial statements 4 of 7, the statement of cash flows, fundamental analysis of corporate liquidity. Hope you will like, share and special request to all to don't forget to subscribe our channel. Today's video is all about one of the most powerful financial statements that often gets overlooked, the statement of cash flows. Profit is equals to cash. Statement of cash flows. If you have ever wondered why a profitable company can still run out of money, this video is for you. Arguably, one of the most important financial reports of a company is the statement of cash flows. As a principal component of financial reporting, the statement of cash flows provides essential insights into an entity's liquidity position by systematically categorizing cash inflows and outflows during a reporting period. This statement serves as a critical complement to the income statement and balance sheet by reconciling accrual-based accounting measures with actual cash movements or actual cash generated by the company. Because of the accrual method of accounting, the net income shown on the income statement does not represent the cash received by the company. The statement of cash flows is organized into three distinct classifications. Cash flows from operating activities. The operating activities includes the primary business activity of the company, exclusive of making investments and borrowing money, represents cash effects from core revenue generating operations, utilizes net income as a starting point under the indirect method, incorporates adjustments for non-cash items, for example, depreciation, amortization, etc., changes in working capital accounts, deferred tax provisions, cash flows from investing activities. Investing activities includes purchasing and selling assets such as buildings, equipment, etc., and purchasing financial assets, and it captures capital allocations decisions through acquisition and disposition of property, plant, and equipment, purchases and sales of investment securities, business combination activities. Cash flows from financing activities. Financing activities includes issuing and repaying debt and making interest and dividend payments. Cash inflows may be the result of selling stock or borrowing money from the bank. From this, it is clear that in this section, the activity includes document changes in capital structure, including proceeds from debt and equity issuances, principal, principal repayments of debt obligations, distributions to shareholders, methodological consideration, indirect versus direct presentation. While both methods yield identical or same results, the indirect method predominates in corporate reporting due to its reconciliation utility. The statement of cash flows, the calculation. Operating activities. To calculate the statement of cash flows operating section, we must adjust net income for changes in non-cash current assets and current liabilities. An increase in a non-cash current asset results in a negative adjustment to net income. An increase in current liabilities results in a positive adjustment to net income. The following formula is useful for calculating operating cash flows. To net income added to the depreciation expenses, add another addition, a decrease in current assets, or subtract an increase in current assets. Add another one, an increase in current liabilities, or subtract a decrease in current liabilities. An increase in accounts receivables means that others owe money to us, so it has a negative impact on cash and vice versa. Similarly, a change in the reserve for doubtful debts will also have an impact on the cash flows. Investing activities, purchasing property, plant and equipment, uh, and investments such as stocks and bonds are examples of investing activities on the statement of cash flows. These items are straightforward on the cash flow statement since purchasing these items will cost money. An increase in any of these accounts causes a negative change on the cash flow statement. Likewise, selling equipment and investments generates cash and is a positive event on the cash flow statement. Financing activities. Funds generated from the issuance of stocks or bonds will create a positive change on the cash flow statement. A positive change in long-term debt and a positive change in shareholders' equity are positive events on the cash flow statement. As mentioned at the beginning of this section, the statement of cash flows is one of the most important financial documents. A company may look profitable on the income statement, but if it is not collecting its receivables, it may soon find itself short of cash. Likewise, a company may show an increase in cash on the balance sheet, but looking at the statement of cash flows may indicate the cash is a result of selling of its assets. The statement of cash flows, the important points. Formula: net income depreciation divided by amortization plus or minus changes in working capital plus or minus non-cash items is equals to net cash from operating activities. Analytical significance. The statement enables stakeholders to assess the quality of earnings through cash realization. Evaluate capital expenditure decisions. Monitor financing strategies and dividend sustainability. Identify potential liquidity constraints. Advanced analytical metrics. Free cash flow or FCF, operating cash flow minus capital expenditures. This metric indicates discretionary cash available for debt reduction or share repurchases or strategic investments or EBITDA limitations. EBITDA limitations. Well, what are these limitations? While commonly referenced, EBITDA, that is earnings before interest on taxes and other debts, suffers from material deficiencies as it ignores working capital requirements, excludes necessary capital reinvestments, overstates available cash by excluding tax obligations. Critical interpretation considerations. Financial analysts must carefully evaluate sustainability of operating cash flows, capital expenditure requirements, financing cash flow trends, the interplay between all the three activity categories. Conclusion: the statement of cash flows represents an indispensable tool for comprehensive financial analysis, providing unique insights into an organization's cash generation capabilities and financial flexibility that cannot be derived from other financial statements alone. Proper interpretation requires careful consideration of all components and their interrelationships to form an accurate assessment of corporate financial health. Analytical significance: the statement of cash flows helps stakeholders evaluate the quality of earnings through actual cash generation, assess the adequacy of capital expenditure funding, monitor financial strategies and dividend sustainability, detect early warning signs of liquidity issues. Well, that's it for today. Hope you like our video. For more videos, please do not forget to like, share, and subscribe to our channel, Accounts and Finance with FARSK. Thank you. Have a great day.